The Free Thinker Show. Ignite your mind, challenge the norm.
It's kind of wild when you think about it, how a single equation can end up like totally reshaping entire industries.
Yeah.
It really makes you wonder what other hidden connections are out there,
Absolutely.
the things we're just completely missing.
Mm-hmm.
Well, today we're going to be diving into one of those connections, one where physics and math and Wall Street, they all kind of collide.
Yeah.
And get this, right at the heart of it all
Mhm.
is this mathematician, Jim Simons.
Okay.
And he used that very equation that we're going to be talking about to basically beat the market for 30 years straight.
It's pretty amazing. What's so cool about this is that it's not just about Wall Street, right?
Right.
It's about like this very fundamental quest to understand randomness itself.
Okay.
Like Brownian motion, but instead of, like microscopic particles, we're talking stock prices.
Okay, so hardcore math to decode the financial markets.
Yes.
But before we get to Simons and his algorithms and all that, we kind of have to go back in time.
Yeah.
Way back to like how we even got here.
Absolutely. So our journey starts in ancient Greece
Okay.
around 600 BC with this philosopher named Thales.
Okay.
And he's considered by many to be the first recorded options trader.
Options trader.
Yeah.
Thales.
Yeah.
As in like togas and olive wreaths Thales.
The very same.
Wow.
So the story goes that Thales was pretty sure there would be like a massive olive harvest that summer.
Okay.
Now, he could have just, bought olive presses outright, figuring they'd be in high demand, right?
Right.
But he was short on cash,
Okay.
and he saw an opportunity.
So what did he do? Did he like invent the world's first olive futures market?
Not quite, but he did something remarkably similar.
Okay.
He goes to these olive press owners, and instead of like buying the presses outright, he pays them this small fee to essentially reserve the right to rent the presses later at a set price.
It's like putting a down payment on a massive olive pressing party.
Exactly.
Right.
And this, my friend, was the first recorded instance of what we know as a call option. It gives you the right, but not the obligation, to buy something, in this case, olive press rental time, at a future date for a price agreed upon today.
And call options are still a big deal today, right?
Huge.
I mean, it's all about betting on whether the price of something, whether it's a stock, a barrel of oil, whatever, is going to go up.
Exactly. And there are put options too, same idea, but you're betting on the price going down.
Okay.
But the beauty of options, right, is their versatility.
Okay.
You can use them for leverage to like amplify your gains, or like Thales to hedge against risk,
Right.
limiting your losses if it turns out you're wrong,
Right. Right.
which is always a possibility.
Always. Yeah.
But for centuries, like figuring out the right price for an option, that was basically just guesswork.
Really?
Yeah, like a giant game of financial chicken,
Wow.
Just gut feeling and speculation.
Okay.
But that all started to change in the early 1900s
Oh, yeah.
with this French mathematician named Louis Bachelier. Now, Bachelier, he was fascinated by these seemingly random, like up and down fluctuations of the stock market. And he was convinced there had to be a mathematical way to understand it.
And this is where the physics comes in.
This is it.
Okay.
Bachelier was the first to apply this concept of random walks to stock prices.
Random walk.
Yeah, and this idea, it actually originated in physics.
Okay.
And it basically says that a particle's movement, it's unpredictable because it's constantly being bombarded by all these unseen forces.
Okay.
Kind of like a pinball in a pinball machine.
Okay, so Bachelier saw stock prices kind of like those jittery particles in Brownian motion,
Exactly.
constantly being jostled around by like a million tiny, unpredictable events.
You got it. And this was radical thinking at the time.
Really?
Oh, yeah. Instead of trying to predict individual price movements, which Bachelier thought was impossible, he focused on the probability of different outcomes.
Okay.
And what he found was that over time, stock prices, they tend to follow a normal distribution.
That classic bell curve shape.
Exactly. That's the one.
Okay.
So Bachelier, he gives us the math of randomness.
Okay.
But how do we actually use that randomness, right?
Yeah.
To make decisions, to manage risk out there in the market?
Yeah, how do we use it?
That's where Ed Thorpe comes in.
Okay.
That's right. Ed Thorpe, he was a physics PhD
Okay.
with a real knack for, shall we say, beating the odds.
Okay.
But he didn't start with the stock market.
Okay.
He started with something seemingly simpler, blackjack.
Okay, so how does a physics whiz go from equations to cards?
Well, Thorpe realized that in blackjack, by keeping track of the cards that were dealt,
Oh,
what we call card counting now,
right.
he could actually shift the odds in his favor.
Wow.
It was all about understanding probability,
Okay.
and adjusting your bets based on that knowledge.
So he used math to game the system, basically.
Yeah, pretty much.
I'm guessing casinos weren't too thrilled about that.
You're right, they weren't happy.
Yeah.
Thorpe's winnings, caught their attention, and they definitely made his life pretty difficult.
Really?
Oh yeah, they would try to distract him at the table,
Wow.
Eventually, they resorted to using multiple decks of cards just to make card counting much harder.
Wow, so they changed the game to stop him.
Yeah, they basically forced him to find a new game,
Okay, so sounds like Thorpe needed a new challenge.
Yeah, exact.
Bigger game, enter. Wall Street.
Exactly. So Thorpe takes the principles of hedging that he had honed, at the blackjack table,
Right.
and he applied them to the world of finance.
Hedging, explain it to me like I'm still at that blackjack table trying to remember if a 10 just came out or not.
Okay, so imagine you're betting on a stock to go up.
Okay.
Right. Hedging is like placing a strategic side bet that it might actually go down.
Okay.
So it's like creating a safety net
Okay.
for your investments. So even if your main bet is wrong, you're limiting your potential losses.
So it's like having your cake and hedging against eating it too. I like it.
Yeah, that's a great way to put it. And Thorpe, with his deep understanding of probability,
Yeah.
became a pioneer of something called dynamic hedging.
Dynamic hedging, what's that?
So essentially, it's like constantly adjusting those side bets, right? As
Okay.
prices go up and down, trying to create a situation where ideally your gains and losses, they kind of balance out.
Okay.
He called it building a risk-free portfolio.
Risk-free. So did he create this magical risk-free portfolio and just like ride off into the sunset with a mountain of cash?
Well, he achieved incredible returns for his hedge fund,
Okay.
but it wasn't quite that simple.
Okay.
I mean, Thorpe's methods, they relied on really complex mathematical models.
Right.
And it required constant adaptation, to stay ahead of the market.
Right.
But his work was groundbreaking.
Okay.
And it laid the foundation for what came next, the Black-Scholes-Merton equation.
The equation that changed everything, supposedly.
That's the one. This is where things get a little complicated.
Right.
But the idea is actually pretty elegant. So building on the work of Bachelier and Thorpe,
Right.
Fisher Black, Myron Scholes, and Robert Merton, they developed this model to figure out the fair price of an option.
So before this, option pricing was more of a guessing game.
Pretty much.
And Black-Scholes-Merton brought the hardcore math.
Yeah, that's a good way to put it. Their model took into account a bunch of factors like the current stock price,
Okay.
the option strike price, so that's the price you agree to buy or sell at,
Right.
how much time is left until the option expires,
Okay.
and the expected volatility of the stock, like how much is it expected to move up or down.
And this wasn't just some academic exercise, right?
No, not at
This
that.
actually changed how markets operate.
It revolutionized finance.
Really?
Yeah, it led to the explosive growth of something called derivatives markets.
Derivatives, what are those?
So these are financial instruments like options,
Okay.
where the value is derived from an underlying asset.
Okay.
We're talking trillions of dollars.
Oh.
Sloshing around, impacting everything from like how airlines hedge against fluctuating oil prices to
Dare I say it, the GameStop thing a couple years ago.
exactly.
That was like watching a financial roller coaster in real time.
And options were a huge factor in that whole thing. That ability to control a large amount of stock with a relatively small investment, that's the power of options.
Right.
That was a key ingredient in those crazy price swings.
So we've gone from olive presses to like trillions of dollars in these derivative markets.
It's pretty amazing.
All thanks to this quest to like understand and predict market movements.
Yeah.
It makes you wonder though, like if everyone's using these fancy models now,
Yeah.
can anyone really outsmart the market anymore? If everyone's using all these complex models now, is it even possible to like gain an edge in the market?
Right. And that's where Jim Simons comes in.
Okay.
So Simons, he built this hedge fund called Renaissance Technologies.
Yep.
And this is the really interesting part. Instead of hiring the typical Wall Street hotshots, he filled his team with mathematicians, physicists, code breakers,
Wow.
people who were experts at finding patterns in massive data sets.
So if anyone could find those hidden market signals, it would be those guys, right?
Exactly.
What was their like secret sauce? How'd they do it?
They used this statistical model called a hidden Markov model.
A hidden Markov model. What is that?
Okay, so imagine trying to predict traffic patterns, right?
Okay.
But you can't actually see the roads.
Oh.
You just have, like, snippets of information here and there.
Right.
That's kind of what Simon's team was doing, but with markets.
Interesting.
They used, like, subtle clues and correlations to try to figure out this underlying traffic of money.
So they weren't trying to predict if, like, one individual stock was going to go up or down.
No, much broader.
They were looking for these, like, bigger patterns to give them an edge over the long term.
You got it.
Did it work?
Oh, it did.
Really?
Their medallion fund became legendary for, like, consistently outperforming the market year after year.
Wow, so they really were onto something.
It really challenged this idea called the efficient market hypothesis.
Which
basically says that you can't consistently beat the market because all the information's already out there, it's already priced in.
Okay.
But Simons and his team, they kind of poked holes in that theory.
So did they disprove the efficient market hypothesis?
It's hard to say for sure, but,
Yeah.
Simons' success definitely made people rethink things.
Okay.
It suggested that even in a market as sophisticated and complex as ours, there might still be these pockets, these little, pockets of exploitable patterns.
Hidden in the chaos.
Yeah, exactly. Especially if you've got, the right tools and a really, really good understanding of the data.
Okay, so what happens if we figure it all out?
What do you mean?
Like, what if we actually managed to unearth all those patterns, all the inefficiencies? Wouldn't that, in a way, make the market truly random? Like, if you take out all the things that make it predictable.
That's a really, really interesting question.
Right.
Like, if we eliminate all the inefficiencies, does the market just become this perfect reflection of randomness?
And then all those discoveries, all those models and algorithms, they become useless.
It's like a fascinating paradox, right?
It really is. A lot to think about.
Yeah.
So as we're wrapping up this deep dive into,
Yeah.
physics and math and the madness of markets,
Yeah.
what's the big takeaway for our listeners?
I think the key lesson here is just how interconnected knowledge really is,
Yeah.
We've seen how these ideas from physics, from math, even from gambling, they all kind of come together to reshape how we think about, risk and markets.
Right.
And I think the more we can connect those dots, those seemingly, disparate dots, the better equipped we'll be to navigate this crazy complex world.
And maybe even uncover a few profitable patterns along the way.
Exactly.
Always a plus. Well, thanks for joining us for this deep dive.
It was a pleasure being here.
Until next time, keep those minds curious and those portfolios balanced.